Hi there traders, and welcome to the latest edition of the Keyzone Traders Frequently Asked Questions video series. Now, something that you have to learn very early on in your trading journey, and something that's actually not taught to retail traders when they very first start trading, is slippage, and actually how to deal with slippage and what it is. So that's going to be the topic of this video. Hi there traders, so what is slippage? Slippage is basically where you place your market order, and when the market gets to that order there is not enough liquidity to fill you, so it actually fills you at the next best price, which might be slightly worse. Generally speaking, it's slightly worse than the price that you've actually put in to your broker. Now this can affect your risk to reward. This is why I advise my clients, especially when they very first start trading, to trade with highly liquid assets. So these are frequently traded assets that have a lot of volume. So these are things like, the major index markets, major currency pairs, oil, gold, those sorts of really highly liquid asset classes, so that because with those that the liquidity is there, that even when you experience slippage, the slippage is very minimal, so it doesn't have a material effect on your risk to reward. If you're trading very illiquid assets and maybe something more sort of like obscure stocks and things like that, your slippage can have you can experience some huge slippage, which then really affects the overall risk to reward and the viability of the trade that you're taking. So it's really vitally important that you understand this and how it can affect your risk to reward, and then how you're going to react to it. Now, when it very first happens, if you're not aware that it can happen, sometimes it can throw these emotional things because it's like an unknown and people can panic. But actually, as long as the slippage is small, like it generally speaking is in the highly liquid assets, then it's not really anything too much to be concerned about. It's just part and parcel of trading. It's a cost of doing business, as they say, and it really shouldn't have a material impact. Any slippage you experience on sort of like euro, dollar, cable, FTSE, S&P, those sorts of really highly liquid assets, it shouldn't have a material impact on your overall viability of your trade, and you should just carry on and stick to the same parameters as you were going into the trade, with the same stop loss, the same target. If the slippage, is sort of quite substantial, so you're talking sort of like up towards 10% of the risk that you're taking on, then you need to start thinking about, does it affect the overall viability of the trade? And if it does, maybe you need to come out of that trade pretty quickly rather than allowing to take a full stop, because if you get slippage, generally speaking, you're going to have to take on a little bit more risk to keep your stop in the same place. So if it's minimal, then it's not so much of a concern. It's nothing really too much to worry about. Like I say, it's just the cost of doing business. But if it is quite a substantial amount, you're taking on a lot more risk. Your target is a much closer, so therefore your risk to reward is out, and you actually need to think about closing that trade, because actually the edge on that trade is not there. So something to think about, something that's not spoken a lot about in the retail space, but something that certainly traders need to be aware of that it can happen, what it is, and how to react to that when that situation arises as well.